Hi, this is James Eng of Old Capital, and today we're going to be going through a multifamily financing update for January 2023. So, Happy New Year to everybody out there, and buckle in. This is going to be definitely an interesting year compared to the previous years. So, we're going to start with this picture. I thought was applicable in terms of praying for a pause. So, praying for a pause. And so what I mean by that, and we'll get into it across how this is going to be applicable to investors, in terms of a Fed pause, right? So when I'm talking about praying for a pause, when the Fed pauses, it's going to signal some of these things. So one is inflation is cooling. Your debt service on floating rate loans is going to go down. Your interest rate caps are going to come down. Your potentially rate cuts are on the way, on average about 9 months away. And then also your 10-year Treasury, which is going to be, the base rate for a lot of deals on refinances is going to start coming down. So in terms of praying for a pause, I thought that was super applicable for January this year as we wait, right? So let's jump in and talk about sort of what we're seeing on the macro front right now. CPI just came out for December, and it was on its way down. So it was about 6.5, which was down from 9.1 in June, which is great. Most people on the projections right now, we have a meeting in February, we have a meeting in March. People are projecting about 25 basis points more those two meetings, and then we'll end up sort of topping out around 5% on the federal funds rate. So that's the projection right now. Obviously, it is still early. People need to see inflation continue to come down, and potentially this doesn't run away from 5% to 5.5% to 6% like it did last year. So this is the forecast right now. Sort of base case analysis is sort of topping out at 5% and then pausing there. So this May meeting, if we see the federal funds sort of pause here at 5%, I think we'll start triggering some of these items that I'm talking about here, and we'll go through once we see that pause what that's going to indicate for you as an investor going forward. So usually there's a delay, right? So when the Fed hikes, they've done it usually not this fast, but super fast this time. There's a delay between the Fed hikes and inflation and unemployment, right? So it sort of works its way through the economy. And so right now, these Fed hikes are having an impact on CPI, but it's still 6% right now, year over year. So it's going to take a while for CPI to come back down. It might take another 12 months or so. Usually it's taken about 1.5 years, 1.7 years. But everything seems to be faster this time. So hopefully the rate hikes have gone up fast enough that CPI comes down. I've seen some forecasts that they're hoping CPI gets down to 3% by the end of 2023. So I think when that pause happens, you're going to see some of that working through the economy, and hopefully we get that inflation down. This chart on the right talks about unemployment, and I think we're seeing layoffs come and being announced, but it really hasn't trickled through into the unemployment data. So unemployment's still sitting at about 3.5 right now. So once that pause happens, we'll probably start seeing unemployment start increasing from there. And so, a lot of issues that are coming up right now are when you have floating rate debt, you have to buy a cap, and you're buying a cap on SOFR, which basically reflects the cost or the interest rate that the federal funds is having, right? So let's say federal funds is at 5%, and then you buy a cap. Let's say you buy a cap at 3%. Well, that cap provider is paying you out already day one. And so there's really a combination of cost in providing this cap. One is the actual dollar amount they have to pay you, but then also the uncertainty, right? So if this thing runs up, if SOFR goes from 5% to 6% to 7%, there's a lot of uncertainty in that. And so once they pause, the Fed pauses, those cap costs have come down historically. And so once we see these cap costs come down, that's going to help you buy lower lower strike rates on your floating rate debt, and also for your escrows. So people who are on Fannie and Freddie, if they have any monthly escrows, those will come down as well. And so we're going to talk about where those are at right now as well, but it is exceedingly high right now. All right, so when we see this pause, it's going to signal a couple things, mainly on the right-hand side. So whenever we've seen a pause, it's been anywhere from about 5 months to 15 months before the first cut. And so if we see a pause in March, that puts us at about December before the first rate cut. And that obviously has implications for your interest rate cap costs, but then also your debt service. All right, so 10-year Treasury started out the year sort of 3.7, 3.8. It's come back down, probably 3.5 right now. And so it's still hovering in that range. It definitely has come down from sort of the October, November 4.2. 3.5 add about 200 basis points to that rate or that 10-year Treasury. And that's pretty much your Fannie Freddie rate on a yield maintenance deal. And so if you're at 5.5, a lot of deals can still get done, whether it's refinance or acquisition at 5.5. So 3.5 seems to be a good rate. Obviously everybody would love to still, see the 10-year Treasury at 2%, but right now nobody's really projecting that. When we see the Fed pause, people are projecting that the 10-year Treasury is going to come down. Historically, it's come down about 120 basis points. So that could get it down to, around 3% in 12 months, and then potentially even 2.5 in 24 months. So that is still anyone's guess, but historically, that's sort of what has happened when the 10-year Treasury has come down, and that'll make it easier to refi. So this pause has a lot of implications across your actual cost of debt, your interest rate caps, 10-year Treasury coming down. Like all these things are rippling through once the Fed pauses. All right, so I get a lot of letters, whether it's Warren Buffett putting out stuff, whether it seems like everyone put out a year-end letter. And Jeremy Roll's been on I've interviewed him a number of times, and I thought he articulated this very well. And this is not meant to scare you, but it is to prepare you. And so here he lays out sort of a typical recession, right? So there's layoffs, unemployment goes up, there's less demand for apartments, and then rents come down, which is going to lower your NOI and lower your value. So here I give you the example of, let's say you bought a deal and the NOI was $1 million. Your cap rate was 4%. That's $25 million that you bought the property at. Okay. So now going into 2023, let's say your rents come down and your NOI drops by about 10%. So I'm just, that could be a combination of rents. It could be a combination of occupancy, but I'm just using 10% just to use a round number. Your value has dropped from 25 million to 22.5 million. So most people could handle that type of drop in terms of value, right? Like it's going to come back up and it'll be okay. So here is what he laid out in terms of not only are rents potentially going down, which is in a typical recession, but the two other things that are happening with this higher inflation is higher expenses, right? So your payroll is higher, your taxes are higher, your insurance is higher. So your higher expenses is cutting into your NOI. And then these higher interest rates, right? Where we sit today, cap rates are expanding because of these higher interest rates. So it's not only your revenue, it's also your expenses, and it's also your cap rate. So if you take that same example, $1 million NOI at 4%, 25 million, and then you sit at the end of this year, your NOI goes down. Let's say it's 850. Your cap rate expands by 100 basis points, which we've sort of seen. Newmark put out some data around sort of different markets, and it's anywhere from 50 to 75 basis points. That was sort of over the last year, but it might go more. Your cap rate goes to 5%. Now all of a sudden your value went from 25 million to 17 million. And so this is a value drop that most people cannot stomach, in terms of they might have a bridge loan at 20 million, they might have a Fannie Freddie loan at 15 million, but there's a lot of loss of equity there. And so, this is obviously going to be different for different markets, different size properties. But, understanding this and realizing sort of where we are in the cycle, and understanding that, like, he quotes Ken McElroy, which is a big apartment operator, and one of his videos he talked about using sort of flat rental growth for 2023, and then probably about 10% increase in expenses. And so projecting your NOI for this year, your budget, making sure you have enough cash on hand to withstand this and sort of make it through and ride it up on the next wave. All right, so this was, Jeremy Roll is a individual investor, but I wanted to also get some market data, right? So I got some market data to show you as well, sort of where we sit today. We're, Yardi Matrix puts this out sort of on a monthly basis. They're seeing rents come down. I think it's okay to see rents come down on a monthly basis in sort of the slower months. Overall for 2022, they're still up significantly. I think about 6% was overall for 2022. Just the back half has definitely been tougher. I would say probably starting August, September, you're seeing rents come down and occupancy come down in those later months of 2022. And, this is one of those things, we don't do a ton of Class A, but Class A is going to impact the overall market dynamics. And some of these smaller markets, we're seeing a lot of deliveries. So 2023, this is at a national basis. This comes out of Brokerage. We were delivering about 300,000 units in 17, 18, 19. And this year in 2023, I don't know how accurate this delivery number is, but it's right now they're forecasting at 565,000, right? So that's an estimate. That's based on, plans, where stuff is, how long it's going to take to deliver. But if this 2023 number is correct, that is a huge increase over the amount of absorption that's projected. So absorption is, the demand for property. So 400,000 units expect to be absorbed or leased, and then you have 565,000 coming online. And so some of these markets where you have over 5% of your inventory in new construction, so whether it's Nashville or Austin, sort of with the larger circles here, that's going to be a lot of new supply for those markets. And so that's going to be a challenge on the Class A side at a national level. And so I wanted to dive in. Brokerage gave not only a national piece, but then also a market by market piece. And sometimes on these forecasts, I think they paint sort of a broad brush around cap rates, around rents, and so I think it's important to look at these and understand just sort of high level where these markets are at. But then you definitely have to dig in submarket by submarket. So let's just start at the top. We're going to look at the 4 major markets in Texas. So Austin, rents at about $1,750. The average price that they have is about $243,000 a door, and then cap rates of about 4.4. I would point out that almost all these markets in Texas are going to have that same discrepancy between deliveries and absorption. But you have to remember also the percentage of inventory coming online. So Austin has a large percentage of its inventory coming online, so it's gonna be a little bit more challenge in the Class A space, and there's gonna be a little bit more volatility. I would say they don't really touch on the tech sector, but Austin definitely is a more tech heavy market, and that seems to be getting hit a little bit harder on the layoff scene right now. So Austin, a couple things to just keep in mind. So 750 effective rent, 240 price per door, and then cap rate of 4.4. So that's sort of Austin in a snapshot. DFW, we're at about 1575 on rents, price per unit about 195 a door, and then cap rate's 4.8. DFW, I think the main thing that they keep saying is really the employment story, the number of employers coming to DFW, and the deliveries are high. It's 35,000, which is probably one of the highest in the nation. But as a percentage of inventory, it's definitely probably in that 3 to 4% range compared to, let's say, 8% in Austin. All right, Houston, effective rent about 1350. Cap rate about 5.3, and then price per door about 165. And then there's still that imbalance. We saw negative absorption in 2022, and then 2023 we still have 8,000 more units coming online. So I think Houston, occupancy is a little bit lower, rents are a little bit lower, so your price per door is a little bit lower down in Houston. And then San Antonio. So San Antonio, actually, the rents they have about 1,300 on effective rent, price per door about 150, and cap rate about 5.2. So if you're going to look at these sort of top to bottom, Austin about 4%, 4.4% cap rate, DFW 4.8, and then Houston and San Antonio about 5.3, 5.2. So hopefully that gives you a snapshot. A lot of times, even I, we're looking at deals, and one day you might get a deal on DFW, a Class B deal, and it's 175 a door or something, and then you get a deal in Houston and it's 120 a door, and it's a Class B deal, and you're like, oh man, this makes all the sense in the world. But you have to make sure that it sort of ties out with the rents and the cap rates, and that you're getting compensated directly. Sometimes you can't just take the same Class B deal and apply it across all the markets here in Texas. There's going to be a lot of variance between some of these markets. All right, so I wanted to add some additional commentary from some other brokers who also put out some stuff. Obviously, the amount of listings is a little bit lighter than what we've typically seen in January, right? So in 2022, in January, we probably got 40, 50 new listings in DFW. I would say right now it's probably in the single digits in terms of new listings coming out, whether that's a combination of sellers not willing to be able to sell, or brokers not being able to sort of get the price that the sellers want to sell for. So some of the stuff that's coming out is just stuff that was maybe listed in 2022, summer of 2022, and then the debt markets were a little choppy, and now people are sort of coming back out and saying, look, I've been in this deal for 4 or 5 years. I want to sell this deal, and I understand the debt markets, but even with interest rates at 5.5, let's say on a Fannie deal, these deals I think can still get done. So I think if they're priced appropriately, which a lot of them are reflecting, that some of these deals are going to get done this year. And then loan assumptions for sure are still out there. It sort of takes the risk off the table. I mean, this is a deal that, has a Freddie Mac SBL loan at 4.15. So that's going to insulate you a lot as well. So loan assumptions and new pricing on some old deals is what we're seeing a lot more of right now. All right, so that really covers sort of the economic and sort of what we're seeing in the multifamily side. Now I want to touch on sort of what we're seeing on the financing side. My background, born and raised in Houston, went to school at UT, and then been up here in DFW since 2006. Was a loan underwriter sort of through the great financial crisis. So it's giving me a little bit of a history lesson here, sort of 2008 to 2012 while I was there. A lot of some parallels, but not necessarily the same so far here in 2023. The past, since 2015, have really focused in on multifamily and been a lender in the space, close to 1.4 billion in loans, and then invested in probably about 40 properties now across all the major metros as a limited partner. So, all right. So current owners, what's my advice for current owners is, cash is king right now, and you need cash for higher debt service. You need cash for interest rate cap replacements. And then if you are on a shorter term loan, like a 2-3 year loan, there might be a gap, right? There might be a gap. Let's say your bridge loan is 20 million, your Fannie Freddie loan is 18. There might be a $2 million gap. And so you're going to need to solve that problem. And that might be coming in with additional capital out of your own pocket. It might be raising money from limited partners. It might be bringing in a new partner into the deal, whether it's preferred equity or rescue capital of some sort, to fill in that gap so that you can get to the other side of this recession. In this, we haven't really, we touched on it earlier in the presentation, but really around lower occupancy and rent growth. If your NOI is going down, covering some of those higher expenses in your working capital, things like that you might need. And then I think you've got to sort of take care of your existing deals before you can really go out and go raise money for new deals, right? So communicating with your limited partners on existing deals, and then watching deals as they come out, whether from brokers or just from other individuals that you work with, whether it's your loan guy or anybody, you're gonna hear about off-market deals, and so you got to be ready for those. All right, so a lot of people are asking, should we be going from floating rate to fixed? And I think a lot of people, maybe who are maybe more experienced sponsors who have done floating rate, are used to this volatility, even though it's been a ton of volatility on the interest rate caps. This is an example of a deal that they had 24,000 a year in interest rate cap payments, and then it went to 360, and now it's 1.2. Right? Most deals just can't stomach that volatility, and so you're hitting a negative cash flow situation. And so a lot of people are refinancing into, I would say, either a lower spread floating rate loan, or they're going to a fixed rate with a step down or shorter yield maintenance penalty. And so when you do that, that basically frees up your cash flow, and then also allows you to buy potentially another cap that's going to reset and get you out from year 3 out to maybe year 5, year 6. And that's going to allow you to sort of kick the can a little bit down the road. And then hopefully, as we said in the beginning, pray for a pause. And then as the pause happens, all these costs will come down. But you've got to get to the other side. Most people, this is one deal. This is $20 million loan. Most people can't, pay $500,000 out as a general partnership team out on all these deals. If they have 4 or 5 deals, it's just too much money to support these deals. So you're gonna have to do something. So this is a deal, the same deal. Some of the things that you have to build into your assumptions are, what do you think interest rate cap costs are going to be? What's your prepayment penalty on fixed rate if you do yield maintenance? And then your future impacts, right? So right now, your NOI might be the highest it's going to be in the next 12 months. So it might be time to refi today if you see lower rent growth, lower occupancy, higher property taxes, higher insurance in the future. Today's NOI might be the best NOI. So, if you refi out to a Fannie and Freddie loan, put down a little bit extra money, move it out to a fixed, and just sort of free up the cash flow, it might give you a lot more options, and you don't have a negative cash flow burn, which could impact, your ability to hold the property, right? So getting over to a fixed, yeah, your gain might not be as high, but you still have a gain, right? So I think some people, they get too scared of the prepayment penalty, and then they don't survive to make it to the prepayment penalty and sell the deal. So making sure that you refinance to something versus, one of the things that, Warren Buffett's number 1 rule is don't lose principal, right? So don't lose money. And, some of the, when the market's just going up, everybody's just complaining about, I paid too much in prepayment penalty. I could have made 3x, but I only made 2.5x. Right now, I think some people are looking at the deal and saying, all right, we need to make sure that we get 1x on this deal and get everyone's principal back. So making sure you protect the deal and then worry about the upside when you get to that point. All right. So, why does it make sense to buy multifamily still? I think, in this inflationary environment, leases are going to reset, which are good. I think pricing has reset. So you're probably 15 to 20% below where you were 12 months ago. Getting a higher cap rate, let's say in that 6.5% range, and your debt's 5.5, that's still a good trade-off, compared to everything else, right? So, a lot of office people are moving out, retail moving into multi. So I think multi is still going to have a lot of demand, not only from tenants, but also investors. And then, I'm still waiting for that double-digit cash on cash that we had in 2015, 2016, that, and not solely counting on appreciation. I mean, the amount of deals that sold in 12 months, like that essentially is gone now, right? So you're gonna have to go back to old school double-digit cash on cash and focus in on that, focus in on operations. All right. So, let's talk about opportunities. I think anybody sort of who has hit the or in bridge loans with maybe not a interest rate cap, that's definitely an issue. You're paying 5% plus your spread of, let's call it 3%. So your 8% debt is very expensive. You probably have a cash flow sweep if it's underperforming. And then if you only bought a 1 or 2 year cap, you're definitely more in trouble. So some people are going to have to move deals. And so every deal that comes out, I pretty much just look up what the existing loan is and when they bought it and sort of get the story. And to me, if somebody's moving a deal, after 12 months or 18 months, in the past, that meant, hey, I already made 30%. It's time to go. Value already went up 30%. It's time to sell it. But now that's not the case. And so understanding that, whether if you see a deal out there and you have any questions about the loan, the seller, property management, just let us know. We can sort of track that down for you. The other opportunity I see is really in sort of the 2020 vintage deals that sort of have probably a Freddie floater on it. These escrows have gone up significantly and they have to do something. So they're going to have to sell or they're going to have to refi to really get out of these escrows that are going up, an insane amount until the Fed stops hiking. And here's an example, right? So, a $17 million loan is costing you about $500,000 to replace your cap. So it's about 5% of the loan amount just to replace your cap on a 2-year deal. And so most people just, they don't have that money or the property can't support that amount of money. So they're going to have to do something. All right. So let's look, across the spectrum. Bank loans are sitting at so prime is about 7.5 to 8.5. So in that range, depending on the deal and the strength of the sponsor, they're going to take prime and add maybe 100 basis points. Freddie Mac SBL has come down with the 10-year Treasury coming down about 70, 80 basis points. It's, in that 6 to 7% range. Freddie Mac conventional, Fannie Mae, they're about 200 over. So they're still about 5.5. And then non-recourse bridge, we're seeing most non-recourse bridge probably about 350 to 450 over, and then over SOFR. And then so your fixed rate, there's also some fixed rate debt out there, probably close to the 8-9% right now on the bridge loans. All right. So recourse bank loans, this really is for guys that, want a little bit higher leverage. So you can probably get 65 to 70% on these deals, even if it doesn't hit the debt service that required. So that you're usually stronger guarantor, have some secondary sources of income. We're seeing rates about 7.5 to 8.5. So if you look at this historical chart on prime, and actually, it's sat at close to 3.5%, and then it has sort of rocketed up like federal funds rate. But this was the last one, big 2007, it stopped at sort of probably 825 on this chart. So it looks like we're sort of getting to the same spot on prime. So if it's sitting at 7.5 today, we get to 825, that's about 75 basis points more. And, hopefully the pause comes. So that's just another historical data point on the prime. Here's a deal that, we did 5-year term, 18 months IO, no prepay, and closed in about, I think this one's about 45 to 60 days, but, recourse bank loans can close pretty quickly once you get them under contract. All right, Fannie and Freddie, we're waiting on the final numbers to see if they hit the numbers for 2022, but I don't think they did. 2023, they got a little bit less money, 75 billion, but they are definitely quoting a lot of business. And I think having a little bit more sort of range bound 10-year Treasury, right? So instead of, 10-year Treasury just went from, 1% to 3%, almost up to 4% just all of last year. And so that there's so much volatility in that space that it was very hard for people to underwrite deals. And so now that it's been sort of sitting around 3.5%, it makes it a lot easier to underwrite deals and have confidence to close deals. So Fannie and Freddie are definitely going to be there. The shift in the amount of business that we did last year there was a lot of bridge. Probably 75% of what we did was bridge. And now this year, it's probably going to go probably closer to 50-50 or even, 60-70% Fannie Freddie, depending on, what people's appetite is to just go out and get 5.5% money versus 7 or 8% money. In Fannie Freddie, I would say understanding early rate locks, understanding index locks, those are key to make sure that as soon as, if you can, I guess one thing we've learned is if the deal works at the rate that you can lock, you should do the deal before stuff moves on you. If the deal works at that leverage point, at that interest rate, go ahead and lock the deal and get it done. Fannie Freddie are definitely a backstop. They're looking for more affordability, experienced borrowers. And then, protect yourself. If you're worried about prepayments, look at sort of softer prepayment options. And then if you are in a Fannie Freddie floater now, you can move over to a fixed rate. They have different ways, but basically they waive the exit fee either way if you move into a fixed rate. So here's a deal that we did sort of towards the end of last year. Freddie Mac, lower leverage, 10-year fixed, 3 years IO, just sort of set the rate and execute the business plan and not have to worry about your floating rate piece. Majority of the deals on the bridge loan side, definitely underwriting higher debt yields to make sure you can refinance at 5.5%, 6%. Most deals are at 4 to 4.5 over SOFR. So you're starting at about 8 to 9% right now. So before, bridge loans were underneath Fannie and Freddie, right? So bridge loans, let's say it's a 325, SOFR was 0, 325 spread. So you started at 325 and Fannie and Freddie were sitting at 4.5, 5%. And so that has sort of flipped around. And so, when we talk to a lot of bridge lenders, their anticipation for volume this year just isn't there, right? So bridge loans are now appropriately priced and are only used for cases where you just can't get the leverage with Fannie and Freddie. So Fannie and Freddie might be at 50%, and then bridge loans might be at 65, 75%. And so people will use the bridge loan in order to get the higher leverage. Whereas before, people were doing bridge loans on everything, even if it qualified Fannie Freddie. So, here's an example of a deal, sort of classic exterior and interiors, and sort of using the bridge loan to really modernize. And they probably spent $1.5-2 million on the exterior and interiors to bring this deal to market, or bring it up to market to the current rents. All right, so this is probably where we're going to spend a lot of time in 2023, is sort of refinancing out of bridge loans, floating rate loans. We're seeing all-in rates really around 5.5 to 6 on the 10-year fixed or with step down. And then, understanding that, it's going to, right now it's 3.5. Most people on the 10-year Treasury, they're going to want, obviously they want the lowest rate possible, but, at some point you've got to pull the trigger, and depending on where your interest rate cap sit, where your, term is on these loans, you're going to have to make a decision pretty quickly here. All right. So that's sort of an update on January 2023 on financing. I wanted to just do a little bit of sort of why Old Capital, and sort of, some of the third parties have put us at, we were ranked, I guess, number 18 in the nation on multifamily and total origination volume for the last, I guess this was the last 12 months ending sort of Q3 of 22. And so obviously you see some of the larger players, but, we definitely still get our share of multifamily deals out there. And why people choose us, not only is it the deal, it's whether it's the podcast, the conference, speaker series, representing you, the buyer, exclusively, and sort of highlighting you at these different venues, and being part of your team, really. So a couple ways to get involved with us, I would say, is come out to Dallas. We have a speaker series with Greg Willett on February 13th, and then a speaker series with JP Conklin. So if you are on our email list, you'll get the registrations for these and how to register for these. If you're not, just send me an email and I'll send you the links to those and put you on the list. All right, so 2022 closed out We did about 1.2 billion at Old Capital, 127 loans, 13,000 units. Probably the mix, I would say, was probably about 75% bridge and then 25% on the agency side. Maybe a little bit more bridge, maybe 80-20. But, I think, this year going forward, we're probably going to see that go back to about 50-50 between agency and bridge. So if you like this video, definitely subscribe to the channel, like, comment, share. And then if you need help with a specific deal, I'm happy to put together a term sheet. Just send me, T12 rent roll, OM, whisper price. And then if you're looking at a deal to invest in, happy to take a look at it. Just send me the investment package. And then really to start the process, we really sit down with people, go through their personal financial statement and talk about how to set yourself up for the next deal and sort of structuring your team. And then if you're interested in joining Old Capital, send me an email with your resume and we can discuss more offline. Well, I appreciate you joining today's call.